Hey, welcome to another edition in strategic financial management. Our today's topic is portfolio theory and capital asset pricing model. Now, there is no how we talk about portfolio theory without mention of capital asset pricing model, right? Now, we'll first of all define portfolio, then we move from there. Portfolio is the combination of different investments to minimize or to maximize investment return and minimize investment risk. Now, what this means is that having a two portfolio, for instance, you buy Dangote shares, you buy PepsiCo, or you buy Ohando shares. Having three portfolio, you buy Ohando, you buy Fidelity, and Fidelity Bank shares, and also you buy Unilever or Cadbury, right? That is three portfolio. Now, what are you trying to do? Is that you're trying to minimize the investment risks, right? And maximize investment return. Now, when I said investment in this context, investment could be shares, could be bond, commercial paper, fixed income, or capital what? Capital projects. Now, I'll pick these two here, the shares and bonds. Now, you will agree with me that the risk in shares, right? Investing in the shares is different from investing in what? In a bond. Now, investing in the shares, an equity holder is actually expecting a dividend or capital appreciation from their what, from their investment, which may likely fluctuate. It is not certain, it is uncertainty, right? Now, the same thing applicable to bondholder. Bondholder, it is requiring them to like receive their interest and principal as and when due. But what if they failed? What if the borrower failed to pay the interest and principal as and when due? So that is why you will see some people will have shares, will have bond, right? So what they are trying to do is to create a portfolio to minimize the investment risks and maximize investment return. Now, having explained this, having explained this, we shall proceed to the capital asset pricing model, right? The capital asset pricing model is the relationship between the minimum individual return, right? The minimum individual required return, right? And what? And investment risk. Now, what this is saying is that the minimum, we should not forget that capital asset pricing model is one of the method of calculating cost of equity, right? Which is a cost to the firm, while it is a return to the what? To the equity holder. So the equity holder is expecting the minimum amount that the investor can get from his investment. Relationship between the minimum individual required return. For instance, now, what if I invest in Fidelity Bank shares? The minimum amount I'm expecting from my investment, that is the capital asset pricing model, right? That is what it's trying to explain. And what? The investment risk. What is the investment risk here? Is the what? Is the systematic risk. Why? Because systematic risks are risks. These are risks that are not what? Avoidable, right? Which means that there is a relationship between what I'm expecting and the what? And the risk. Now, it is probable that the systematic risk may actually affect the expected what? Expected return, right? Now, we'll get there. Yes, we'll get there. Required what? Return, right? What you are expecting from your what? From your investment. Now, the investment risk is also known as what? Systematic what? Risk. right? That is why I said systematic risk measures what it is unavoidable risk that occur as a result of government policy, exchange rate, inflation. Who knows that the CBN recapitalization policy will come in place in March or April, right? Nobody knows that, right? So what actually affects the stocks, what actually affects your expectation is systematic risk, right? We can't do without that. Now, why unsystematic risks are risks that are avoidable, right? These are the risks that could be avoided that are caused by what? The organization. Now, if I buy what is it called? Unilever shares now, and Unilever need to produce, right? And there is no enough of machine to what to produce, or maybe due to a strike, right? It is going to affect, it is not going to affect my stock, right? It is not going to affect it because why? Is it because it is the only risks that affect capital asset pricing model, the expected risks is what is a systematic, but that is an assumption that the machine breakdown will not affect your stock. It is not possible. But that is why we have the assumption of capital asset pricing model. Now, if there is a machine breakdown, it will definitely affect, right? If they don't they are not producing, right? If they are not producing, how will they generate revenue, right? What I'm expecting for my investment, how will I get it, right? Is it not when they make profit, when they sell, right? So these are unsystematic risks. It does not consider them, but we will get there. So that is what I'm trying to explain here is that systematic risk is what is a risk that can be what that cannot be avoidable, right? Inflation, government policy, right? It cannot be avoidable. Why unsystematic can be what can be avoidable. These are the risks that are caused by what by the entity itself, right? The labor turnover, right? The stock, the strike, and the machine. These are the things that could affect my expected return. But guess what? The capital asset pricing model is saying that the only risk that it recognizes is systematic risk, which is not actually what possible. Now we will get there actually. Now there is assumptions of capital asset pricing model. What are the assumptions? Now the assumption is that no transaction cost. No transaction cost in the sense that if I buy shares from Fidelity Bank, right? Now, it means that I'm not going to incur any cost, and it is a lie. There is a commission, right? Stockbroker will take their commission before, even when you want to take out your money, they collect commission. When you want to invest, they still charge you, right? Right? A commission, just like a commission fee, right? So there is a transaction cost there. No taxation. Now, no taxation. This is purely an assumption. Do you know why? Because what you are actually expecting is dividend or capital appreciation, right? The company is going to be taxable, right? Yes, it's going to be taxable because at the end of the day, it will be profit after tax. So you can't say there is no what? Taxation. That is an assumption, actually. Now, it only considers systematic risk. So look at what I'm talking about here. Systematic risk. Now, I've explained that it does not recognize unsystematic, which is wrong because there could be labor turnover, right? There could be machine breakdown in the process of producing. Maybe they may not able to produce what they are supposed to produce somewhere due. So these are the assumptions of what capital asset pricing model. So it is an assumption that it only recognize systematic risk. While we have it assumes risk-free assets, right? Now, it assumes that you are investing in a risk-free asset. Now, which is not possible. This is an equity, right? It is an equity that you are investing in, right? In shares, you are investing. There is a risk there. The only risk-free asset is what is Treasury B or government bond. So that is the assumption that you are investing in what in a risk-free asset. Now, another thing is that it assumes a perfect market. Why? That information are available. Now, there are some companies that there are some information that you are not privileged to, right? Probably about the existence. Some company may not even give you enough information that you need. You have to check up and down. So it assumes that everywhere, the market is what is perfect, right? You cannot make loss. Yes, part of it is that information, and you will not make loss. Everything is okay in the market. There is no risk. You are good to go. That is the perfect market. All right. It assumes that investor hold diversify what portfolio. Now, don't forget that the capital asset pricing model measures the relationship between the minimum individual required return. That is individual like this. I step into the Fidelity Bank or Ditco to buy shares, right? Now, I bought only that particular shares. Now, can I diversify that particular shares? No, because I only buy only one shares, right? From GT. Since then, I didn't have any shares. So it assumes that investor hold diversify. So which means that it's assumed that you can actually diversify that one stock or one shares that you actually buy in what? In Fidelity. How? So you can only diversify when you have like two to three. You can say, okay, you are actually diversifying, right? That is why one of the purpose of portfolio is what? Is diversification to minimize investment risk and maximize what? Investment return. So thank you.